Sure. Hi everyone. Good evening. I'm Komal Tyagi from Team Taxman, and I welcome you all in today's live webinar overview of the UAE corporate tax with recent developments. But before we proceed, I would like to provide a brief introduction to Taxman. We are the leading publisher on tax and corporate laws in India, committed to delivering the most authentic and enriching experience to our users. Our goal is to simplify the research and compliance for the legal community. We hold ourselves to the highest standards of perfection, skill, and accuracy in everything we do, and our unwavering dedication to this vision has driven us to work tirelessly over the past 6 decades, providing innovative solutions that help our clients grow their practice. We have also developed and maintained the national website of the Income Tax Department with the assistance of our skilled technical team and the editorial. Now, without any delay, I would like to welcome our learned speaker for the evening, Mr. Nirav Shah. Mr. Shah is a chartered accountant with an All India rank in both CA Inter and Finals. He specializes in international tax and finance and advises on cross-border transactions. He has an experience of more than 20 years establishing and managing structures and compliances in more than 12 jurisdictions, acquisitions of business, financing, and succession planning. Mr. Shah regularly speaks and writes on tax and Dubai VAT matters. Thank you, sir, for being with us. Now, before proceeding, I have a few tips for the audience as well. Your mic will be on mute. However, you may post your questions in the available chat box. Your questions will be answered by the speaker during this session or after the session. And a copy of the presentation used in the webinar shall also be sent to you in email for your future references. Now, without taking much time, I request Mr. Shah to address the audience. Over to you, sir. Thank you.
Thanks a lot, Komal, for those kind words, and thank you, Taxman, for organizing this on a very interesting and upcoming subject. Friends, let me tell you this way that UAE has come a long way. From a no tax country, it is now bringing in corporate tax. It has already brought in VAT equivalent to the GST in India, and it has brought in plethora of regulations all across, So we'll just take a glimpse of what is coming up, and we will also at the end compare it for you to understand how it is different from an Indian tax point of view, So we'll compare it with India and in UAE as a comparison, just to make it more interesting and meaningful for you all. So this is the overview of the items or the matters or the headings that we are going to compare. What is it like to be in a tax regime like UAE? What was the need for UAE to introduce the corporate tax? Who are the taxable person, basis of taxation, PE concept, the free zone issue that we have, which is very unique to UAE, calculation of income, losses and grouping relief and transfer pricing, of course, and general calculation of the liability and compliance aspects. And at the end, we will compare it with India UAE law comparison, just to give you an perspective. Now, first of all, like I said, there were no taxes or no compliances in UAE. First time in 2018 is when VAT was introduced as a first tax in the region as well. Of course, in the region, there has been corporate tax, which has been there in other countries, but UAE never had one. So VAT came in 2018. In 2019, so thereafter, UAE signed up with OECD as inclusive framework member for OECD's base erosion and profit shifting project. And as part of that commitment, it had to bring in the minimum 4 standards, whereby then the economic substance regulation were brought in 2019. The transfer pricing compliance in the form of country by country reports were also made mandatory for corporates and entities operating here. And there were other few regulations which changed from an AML and UBO perspective. Then in early 2022, which is last year, is when the corporate tax announcement came in. Then in April, the Ministry of Finance published a public consultation draft on corporate tax, which was open for public comments. And then in December of 22 is when the corporate tax law was issued. So as a result, there was, like I said, because OECD enforced and followed up with UAE to bring them on board as a inclusive framework member. So they had to meet and introduce this corporate tax law. One was obviously a commitment to meeting the international standard for tax transparency, preventing the harmful tax practices, but also all the more reason that OECD is now going ahead with implementing the Pillar 2 project, which is the Global Minimum Tax Project. So as a basis to implement the global minimum tax, the UAE needed a framework to collect that global minimum tax if they had to collect one. So that for as a basis for that as well was this implemented. So corporate tax was brought in as part of that as well. So of course, you all are fairly aware of how OECD is developing and enforcing, and the pace of change which is there from an Indian point of view also on that line is significant. And therefore, all the more reason here that it becomes important for UAE to bring in this tax law. Now, if you compare with Indian laws, it's very simple. The tax rate, there are only two tax rates, 0% or 9%. For all the people which are covered up to 375,000 dirham, which is local currency, which if you convert from an Indian point of view, the threshold is quite significant. So it becomes almost 75 lakhs of rupees, that up to which the applicable tax rate is 0. Only above that is 9% tax rate. And for people which are in the free zone, on qualifying income, which could be any amount, it is 0%. And for the non-qualifying income, it is at 9%. So they lose this basic threshold of 375,000 if you are in the free zone, right? Now, why the rate of 9%? So when UAE was considering, it went around the world. It looked at what is the minimum possible rate that they could bring in, and therefore they tried bringing in it at that rate, which was as low as 9%, which is also lowest amongst the GCC countries. So all of the 6 countries in the Gulf Cooperation Council, all of them have higher rates, except Bahrain, which still does not have any corporate tax. But all the others are at either 10 or 20%, 10 or 15 or 20%. So UAE wanted to bring in lowest possible rate, because then it can retain the attractiveness of being the destination from where, or the place from where one would want to do business, right? So, and even if you look at worldwide, 9% is amongst the third or fourth lowest rate across the world. There are very few countries with 5. There is some with 8.5% rate, and then the 9% rate. So it is very, very attractive when you compare it with any of the countries with which UAE competes. So if UAE wants to become a financial center and is competing with Singapore, Singapore has 17%, 16.5% rate, corporate tax rate, right? So you have a 9% rate. So similarly, they wanted to keep it attractive, and they still wanted to bring in an all-encompassing law, which they can then go ahead and implement it over a period. Now, effective dates. So here, this is a unique feature of UAE corporate tax law, that you do not have a fixed tax year. In India, we are used to April to March as our fixed tax year. Here, here the companies which are operating here has a freedom to choose its own financial year. So it could be January to December calendar year. It could be April to March for a lot of subsidiaries of Indian group which are here. It could be any year. July to June is also there. There is October to September also there. So different people follow different accounting year. And therefore the tax year will follow its own accounting year. So whichever is your financial period, that's when the tax period starts. So any financial period that starts after June of 23 is when your tax period starts. So if you are following calendar year, your tax period will start not before 1st January 24. Similarly, if you are following April to March, your tax period will start only April 24, right? So this is a unique feature of the law, that they allow you to follow whichever financial period that you follow, and that financial period itself becomes the tax year or tax period. Okay. Like any other corporate tax law, there are residents and there are non-residents. Residents and first criteria is legal persons who are incorporated or established in UAE, and there is no condition of whole control or management for the locally incorporated companies. So by default, moment you are registered in UAE, you are a resident person. Then the natural person. So though it is a corporate law, we cover natural person to the extent that they do business activity in UAE. So natural person who conduct the business activity in UAE, those activity will be taxed and not the personal income that they earn. Okay, and then if there are foreign entities which are not registered in UAE, but they are effectively controlled and managed from UAE, then those are also treated as a resident for the UAE corporate law purpose. Um, Unlike many other countries, UAE has also incorporated the permanent establishment criteria within its corporate law. So you don't need to go to the treaty and look at permanent establishment criteria. Within the non-resident segment of the corporate law, where non-residents could be still regarded as taxable person if they have a permanent establishment, if they have domestic source income, or if they have any nexus. So nexus conditions like India having significant economic presence and other things is not specified, but they've kept it open that if tomorrow OECD, if after a few years OECD decides certain to be nexus, then that nexus condition can easily be incorporated through this route, and therefore they have kept that provision open. Now, we need to understand that in terms of law and applicability, they have kept the scope very wide, but there are certain aspects which are not going to be operational immediately, and they may be operational over a period, and we'll come to that in more detail. Okay. So having seen what is taxable person, what are the basis of taxation? So like India and like any other country, it is a worldwide basis of taxation. So any resident earning worldwide income is subject to tax in UAE. However, for natural person, because the taxation is specific to its business activity being carried on locally, therefore only the business activity which is in UAE for a natural person is taxed. So you can say that it's in a way territorial from a natural person point of view. Okay, so we have a dual system as well, unlike many other countries. Right, and then non-residents, like anywhere else, is taxable only on this income which is sourced from UAE, and that again they have defined very exhaustively what is sourced from UAE. Like we have chapter section 9, they have also defined as what is source-based taxation. So, and what is deemed to be sourced or what is considered as being sourced from UAE. So that is also, we'll come to that in a little bit more detail. So non-residents are only taxed in the income that is sourced from UAE, or if non-resident has a PE and income is attributable to that PE, permanent establishment, then that is taxed in UAE, right? So we're clear so far on the basis of taxation who is covered. Now let's look at individuals. So like I said, it's very interesting. It's corporate tax, it's not personal tax. So individuals are not supposed to be taxed on its normal personal income, right? So only individuals who conduct a business or business activity. So only the income from that business activity, and that too, that business activity has to be in UAE. So if I as an individual have set up a company in America and I'm doing some business there, that's separate. That's not a business activity which I'm conducting in UAE. So that can still remain outside the scope. And if I as an individual earn anything personal, which is salary, interest, or even pure investment income, which I earn in personal capacity, all those remain non-taxable, right? Now, which category of business they will tax is yet to be determined through a cabinet decision. So that we are still awaiting. And business definition is as wide as we understand in normal sense, that any activity which is conducted regularly on an ongoing and independent basis by any person, right? So that will be defined as business, and income which is derived from that business in UAE will be subject to tax in UAE. So individuals are only subject to tax in relation to this business income. Earlier, when the consultation draft came, it was linked to a license. So UAE works on a license regime. So if an individual has taken a license to do any business, then that license should have been taxed. But then when the law came out, they moved away from that and they said any business or business activity which we will specify will become taxable. So now we have this, that individuals are taxed only in relation to business or business activity that they carry on in UAE, not anywhere else, right? So that's for individuals. Now, when we look at others, we also have something as known as fiscally transparent status for unincorporated partnership or JVs. So they could be considered as fiscally transparent, and those respective share owner. So if you have a joint venture and there are two parties and they own 50-50 that joint venture, then joint venture can be fiscally transparent, and those individual owners can then offer the 50% income in their own hands to tax, right? So they will be considered as conducting that business, and they will be taxed on that uh, on that portion. And similarly, like trust in India, we have a concept of a foundation here. So this foundation and trust can also have an option to elect to be a transparent entity, and therefore the settler or the trustees can then become taxable in their own right on the income that comes to them, right? But there are certain criteria when one needs to meet before they get that status, right? Now, PE concept, again, for a lot of you who are practicing international tax in India as well, you must be very familiar with the permanent establishment concept. And whatever is there from a treaty perspective is now incorporated here in the law as well. And it's very similar concept to what we are used to understanding as a fixed place. Any branch, office, factory, building site, or a construction project will last over 6 months, and it excludes the preparatory or auxiliary activities. And any dependent agent who has who has an authority to habitually exercise authority to conducting or negotiating or concluding contract, so if you have that, then that dependent agent can also be regarded as a permanent establishment of that foreign principal, and therefore that also triggers taxability from a UAE point of view. So one needs to be careful of whether a foreign person has any permanent establishment in UAE, and therefore that can also expose them to taxation locally, right? Now, very important to understand what is UAE sourced income, because so non-resident mostly are going to be taxed only on the source basis of taxation, and therefore one needs to understand sourcing rules, but also equally important for residents as to what is considered as sourced from UAE, right? So this both are very important. So any income which is derived from a UAE resident, any income which is derived from a non-resident person who has a PE and that income was attributable to that PE, both is considered as source. Any income accrued or derived from activities which is performed in UAE, or if you have any assets which are located here, or there is capital which is invested here, or you use any IP rights here, right? And in terms of entertainment and other, if those services are performed or benefited from in UAE. So all of these cases are covered as accrued or arisen in UAE. And there are also miscellaneous category where they are saying sale of goods in UAE, provision of services which are rendered, utilized, or benefited from UAE, and right to use IP. Insured assets are located in UAE. So if you gave an insurance policy, maybe from London or wherever, but if the insured assets are located in UAE, that can still be attributed or considered as accrued in UAE. And similarly for lenders, if the borrower is a UAE resident person, then that lending arrangement and therefore the interest which is arising therefrom can also be considered as source from UAE. So again, similar to various other concepts, But only thing from Indian point of view, our Section 9 also has some deeming fiction. So here at least we are not going into the deeming fiction, right? And we only are restricting to accruing or arising and giving different example from that point of view. Okay. Uh, Unlike many other countries, the exemption list here is very, very small. Therefore, their idea, even when they implemented VAT, was to cover everybody. So here also the idea is to cover most of the organizations or the companies which are set up here. So exemption is only for government or government entity, and where they are carrying on their sovereign function, or entities wholly owned by government, and if they are specifically listed in a cabinet decision as carrying on certain government function, or if there are businesses which are engaged in extraction of UAE natural resources or related non-extractive activities. So just to give you an idea, UAE always had corporate tax on oil and gas companies which used to extract oil and gas from the region. Most of them are government-owned companies, but those who are paying taxes under local emirate level decrees. So they have continued them to continue paying under those decrees and not change that part. And therefore, they are exempt under the federal corporate tax law. So those entities remain subject to the emirate level taxation, which is again set at a very high rate, anywhere between 45 to 55%. So those continue to get taxed at that rate, which are mostly government entities. But and those are engaged in extraction of natural resources. So those will get taxed at that rate under Emirati decree, and they are therefore exempt under the federal corporate tax law, right? Similarly, we have public benefit entities, which could be charities or not-for-profit organization, which if they are listed in a particular cabinet decision, then they will be exempt. Investment funds, like in many other countries, it has a tax transparent status, so that fund itself is not a taxable entity, and the investors there become directly taxable. So the same concept, the fund is exempted. And similarly, public or private pension or social security funds are also in the exempt list if they meet certain conditions, right? The exemption list is very small. It's not linked to any industry or sector. It's just certain type of entities which do those specific businesses which are excluded for this purposes, right? Um, we have a very unique situation in UAE where unlike in India across, you'll have few SEZs, we have close to 40 odd free zones across UAE. And therefore, it is very unique that how do you treat and how do you give the benefit to this free zone entities, you know? So free zones were started maybe 20 years back to attract more and more businesses to set up here and provide them a conducive atmosphere to operate and work from. And therefore, they were promised that you will have tax-free status and this and that and all a lot of stuff, you know. Now, because there were no taxes there, one could promise that. But since now a federal corporate tax law is coming in, they are saying that, okay, we will try and honor the commitment of those tax-free status to the extent possible. So all that they have said is that, look, we will not give it to everybody who is registered in the free zone. But if they meet certain criteria that we prescribe, you will get a 0% tax rate. Like we saw, the tax rate for free zone qualifying income is 0%, right? So what is the requirement? So it's that in the free zone, you have to have substance. So you have to have proper physical office, you have to have people, you have to have resources, and you need to be carrying on actual activity from UAE. Then you should be earning certain qualified income. The qualified income could be in relation to the activities that you do outside UAE, a third port trading, or any other services of similar nature. If you're doing it, and of course, the qualifying income criteria is yet to be specified of what they will regard as qualifying income, right? But those which are in the free zone, which comply with this following condition, like maintaining substance, derives qualifying income, has not elected to be subject to corporate tax, and complies with transfer pricing. So for every free zone entity, it's mandatory to comply with transfer pricing. Plus, it's mandatory for them to register and file return. And we do expect that probably it will be also mandatory for them to audit and file their audit financial statement, but that's still to be notified. So if you do all that, and if you then earn qualifying income, then you get a 0% rate. And then if you do not have the income which is qualifying, then you are subjected to tax at 9% like everybody else, right? So that's the basic proposition for a free zone company. So please remember three things. Every free zone company registered in a free zone is not entitled for a 0% rate. Only those which meet this substance test and the other conditions will enjoy 0% rate on only qualifying income. The qualifying income and what will be regarded as a qualifying income is yet to be prescribed, but only those income will get 0% rate. All the other will have 9% rate, standard rate, right? And two more things is that they have to comply with transfer pricing. So every transaction has to be at arm's length, and you have to still register and file the return. So you are not exempted from the compliance, right? So these are important things to remember from a free zone perspective, right? Okay. Now, when we turn to calculation of taxable income, unlike India and unlike many other countries, the methodology is proposed to be very simple. The idea here is also that it should not create an onerous responsibility. So they are saying you start with your accounting net profit or loss from a standalone financial statement. We will adjust it for if there is any unrealized gains or losses, if there is any exempt income, right? So if there is any relief, intra-group transfer or anything, if there are any deductions which are permitted, okay. And then transactions with related parties are first to be reduced, and only if they are at arm's length, then they will be allowed. Tax loss relief and any other incentive or any other adjustment is there. And then you can come easily to your taxable income. So what is the example? What is exempt, right? So when we say exempt, only dividend and capital gains are the two sources of income which can get into exempt category subject to some conditions. So if it is dividend on investments made in a domestic company, which is a UAE based company, there are no conditions. Whatever is the amount of dividend you earn from any of the investment in UAE company is straight away exempt. For every other dividend and capital gain, okay, whether in a foreign company or capital gain from domestic company as well, there are three conditions of participating interest to be met. One is that you should have minimum shareholding of 5%, which has to be held for at least 12-month period. And the company, if it is foreign company or if it is domestic, it should be suffering or it should be taxable at minimum rate of 9%, which UAE is charging. So if that is the case, then whatever you earn from such a company in form of dividend or capital gain will be treated as an exempt income. Okay. And of course, for non-residents, income earned from operating or leasing of aircraft or ships which are used in international transportation are also exempt. For a foreign branch or a foreign permanent establishment of a UAE company, we have a choice that either to treat, if the foreign branch is already getting taxed in foreign jurisdiction at a rate above 9%, it can choose to be treated as exempt, and therefore you don't need to add them in your computation, or you added them in the computation and claim the foreign tax credit that you have paid on the income that you have earned from that foreign countries, right? So that's exempt. Now, if we turn our attention to the non-deductible, again, very standard: fines and penalties, donation to non-qualifying entities, interest which is in excess of 30% of EBITDA, 50% of the entertainment and expenditure. So these two are the only two type of expenses which are allowed subject to certain cap, right? So interest, whether you pay to a related party, to a bank or to anyone, the cap is 30% of the EBITDA, earnings before interest, tax and depreciation. So if you have exceeded that, the such excess is then allowed to be carried forward for a certain time. But otherwise, the excess is not allowed as deduction in the current period. And for entertainment expenses, 50% of the entertainment expense is not deductible. So that is what you disallow. Any unrealized gains or loss on capital items, expenditure for earning any exempt income is also not allowed, and any recoverable VAT or GST, right? So this, if you do this amount of adjustment, you come to immediately a taxable income. Now we'll go into the computation. I'll give you some example on computation a little later. There are certain important provisions in the law which we want to cover and highlight to you right now. So one, of course, is the tax grouping provision. So unlike India, we have opportunity to combine the entities into a tax group and file one single common return for all of them. Now, the conditions or the threshold for grouping is very high. It has to be a parent subsidiary in domestic scenario, not a foreign parent and a local subsidiary. Local parent and local subsidiary. Both should be taxable person. So it's not exempt, it's not free zone person and all those. And it should have at least 95% shareholding, voting rights, and entitlement to profit. Because UAE had different regime and the control over ownership and other rights, there used to be various ways and means and options of operating. There used to be a local 51% owner, but he was only on paper. There used to be side agreements, and therefore he was not entitled to profits in the same proportion, and so on and so forth. Now, all that has to be aligned. You have to meet the 95% or more condition, and then only you can be part of the group, right? You should not be exempt person. You should not be a free zone person. All members should follow same financial period, and the taxable income will be determined at a consolidated level. And therefore, all the intercompany transaction will then be eliminated. And then you file only a single composite return, right? So just to give you an example, if I have a holding company which has A company with 98% holding, B with 97, and C with 75, then I cannot include C in my tax group. I can still make the group with H, A, and B, and that's fine. Okay, but C cannot be included. Now, at the same time, when you look at on the right side, if I have a third entity which is C, which where I own more than 95, but it's in a free zone, and I'm enjoying a free zone benefit of 0% tax rate, then again I cannot put them in the same tax group. The tax group cannot include exempt or free zone person, right? So only H company, A company, and B company will make the tax group. Now, when do you make a group? Which is again a very important thing to consider as to how and when one should actually make a group. So if both the entities in the group are going to be earning profit, then you may not be better off doing a group, because then in fact you are losing the basic threshold exemption of 375,000 up to which is 0% rate applied, right? So if we have two entities, I have two threshold, but if I combine them in a group, I don't get that threshold benefit. Okay, so then I might end up paying a little more. Now, however, one needs to remember that if I have an ability to group my all intercompany transactions will be excluded for transfer pricing purposes, right? So I don't need to do transfer pricing compliance if I'm in the group for all those intercompany transactions, right? So that could be a benefit even though you're not getting the threshold. The other thing is that if you have loss-making entities or businesses within the group, then it makes sense for one to combine them, because then at an overall level, you can set off the full losses and only pay the taxes on the net amount, right? So again, it depends from time to time, and it depends on each criteria, each group, whether it makes sense for them to group or not group, and whether they're meeting the conditions or not. No? So it would be subjective in that sense, you know. The another thing is that tax losses. So here there is no cap on carry forward of tax losses. You can carry them forward for as long as you want. There's no 8-year cap, there's no 10-year cap. You can carry it forward for the period till when your business operates. Okay. There is a cap other way around. That if you have carry forward losses, you can only set it off in the year when you have profit up to 75% of the taxable income, right? So indirectly, it is something like an alternate minimum tax that at least on a 25% of your taxable income, you will pay tax. So losses can be set off in the year when you have profit up to 75% of the taxable year of that taxable income of that year. The balance losses, if you still have, then you can carry it forward, but you cannot set off more than that. Okay. And losses can be carried forward as long as more than 50% shareholding continues, or even if there's change, if the business which incurred that loss, that business continues in the end of a new shareholder also. So again, subject to certain conditions, that's also allowed. But what is not allowed is any losses which are incurred before introduction of corporate tax itself, or uh, he became a taxpayer or registered for the purpose of corporate tax, so before incorporation. So all those, and if it relates to exempt income, then they are not allowed, right? So very beneficial provision on tax losses and carry forward. There is also one unique provision which we are going to talk about. So when you have tax group, any transaction internal, purchase, sale, which is intra-group and all are gone. However, even when you are not able to make a tax group, but if you still have more than 75% direct or indirect ownership interest, then you can still get a group relief. And therefore, what is a group relief? Any internal sale or purchase transaction of assets or restructuring you do, all that will be tax neutral. And that you have to maintain these conditions for 2 years to continue to be tax neutral. So you cannot do it only for that 1 year, take the benefit and then change the shareholding of few other things. So that cannot happen. So if it is genuinely within the group and if it is meant for certain restructuring only, then you can take the benefit. There's another unique provision that you can also transfer losses without being part of the group. But if you have this 75% indirect ownership, you can transfer losses of one entity to another up to the maximum limit of 75% of the taxable income of that year. But you can do that without being part of the group. So this is a unique provision under UAE corporate tax law, which one needs to understand. Okay. Like India and like many other countries, we also have transfer pricing, and there are extensive there are extensive documentation requirement. What is unique is that domestic as well as international transactions are covered, because please remember, we do not have personal income tax. So it was very easy for one to shift profit from business to individuals. But that's where they have brought that under the transfer pricing. So anything that is beyond the arm's length will not get that deduction, right? So that's why the transfer pricing rules are there for all the related party and connected person. Now, you know very clearly that if you were making payment today of X amount, now tomorrow once transfer pricing comes in, it has to be justified, it has to be at an arm's length. And only up to that arm's length price or value is when you get deduction. The excess will be disallowed or be taxable, right? So these are just examples which are highlighting that portion. What gets covered? So any transaction with related parties, right? So how are you going to determine related parties? If two or more individuals are related, up to fourth degree of kinship. Please remember this words, fourth degree of kinship. And I'll explain to you a little bit in the next slide. In India, in Indian Income Tax Act under Section 2, we have second degree of kinship, not fourth. So this goes all the way up to the fourth generation above. And anything that gets connected at that level also is a related party. So now you are related directly or you are related through any of the legal entity or any combination thereof. So either you are two legal entities which are owned by two related parties of more than 50% and therefore it gets covered, or one individual one So all those permutation combination of possible are all covered within the examples, right? So that's related party. What is the fourth degree of kinship? It goes up to the great great grandparent. So it's individual and the spouse, their parent and their child, which is first degree. The second degree is grandparent, and therefore uncles and aunts of the parent also, and those child of them also, and then great grandparent, and then great great grandparent. So this is the fourth degree of kinship that it covers. Fortunately, the threshold, unlike India, is not 26%, it's 50%. So only 50% or above shareholding, voting rights, profit, or control over board of director triggers the related party transactions, right? I just wanted to highlight this because it's slightly different from what we are used to in India. What is also unique is that we are now including in transfer pricing something known as a connected person. So even though there is a director or officer of the company, which is not relative, which does not have shareholding, but that is also considered as a connected person through whom the payments could be made out, So they are also, any payment made to them or any of the entities owned by them are also subject to transfer pricing, right? Now, methodology is same as what we have in India. It's transactional methods or profit methods. And as you all who are practicing in this field knows that it's very difficult to apply a cup. So most popular are cost plus generally or TNMM. Are the two methods which are mostly used to do the benchmarking. And similar level of benchmarking is required when it comes to UAE as well. Okay. When it comes to compliance, like your 3CEB, we will also have a disclosure to be filed along with a tax return of all the transactions that is done with related parties, and to be disclosed that and filed. And like any other transfer pricing documentation, a local file and a master file to be maintained. And this needs to be available ready so that if tax authorities ask for, it should be available to be submitted within 30 days of time. Okay. And opening balance sheet will need to be prepared, keeping in mind the arm's length provisions. So when the law kicks in, if your tax year for you is 1st April 24, the opening balance sheet as of 1st April 24 also will be critical and needs to be justified that all the amounts or the values mentioned there are after taking into account the transfer pricing parameters. So there are no uninflated figures which then you take benefit of in the next period. In India, general anti-abuse rules came much later. We know that it came about 4 or 5 years back. Here, it is already operational even before the law came in. As you know, the very simple point is that if any transaction which is being done with only tax advantage to be obtained, then that transaction could easily be disregarded for these purposes. So tax authorities will have wide power to either disregard it or adjust those transactions and deny you the benefit that you intended to obtain. So there has to be a commercial rationale to doing any restructuring from now onwards till the time the tax law becomes effective. And therefore, anything that is done without having that commercial rationale will definitely attract this kind of a issue. So one needs to be careful of what you plan and how you plan. And if you do not have a proper commercial justification, then you can fall foul of the general anti-abuse rules, GAR. And GAR provisions are effective as we speak. So it is effective since the 15th day as when the law was notified in the public gazette, right? So as we speak, it is already in operation, even before the law is actually triggered and come into operation for the others, for other provisions. This is already in operation. Therefore, anything that you do now, one needs to be very, very careful. Okay. So if you look at it at an overall level, the adjustments are minimum. You start with accounting net profit. You have very few things to either put it in non-deductible or exempt. And immediately you arrive at a taxable income, right? You apply the basic threshold of 0% and then balances tax at 9%. If you have any foreign tax credit, you adjust that to the extent of your tax liability and that's what you get as a final tax payable. Okay, very simple to administer. In a sense, the compliance is likely to be very simple. So foreign tax credit is allowed. It's allowed to the extent of the tax liability in UAE, and therefore either the amount that you have paid in foreign jurisdiction or your tax liability in UAE, whichever is uh, lower, you will get it as deduction. Hmm. At the moment, TDS or withholding tax is zero, and therefore even though you have earned UAE source income, the tax rate is zero at the moment, and therefore foreign residents, even if they earn income which are UAE sourced, which continues to remain 0% withholding subject to. There is no compliance and therefore no withholding tax return to be filed also at the moment. But we do expect that in years to come, in next 3 to 4 years, they'll change this rate from zero to maybe a 5 or 10% suitably, and come on par to make it applicable for foreign companies. So foreign companies today, from a UAE point of view, are subject to tax only in two cases. One, if they have a permanent establishment here, then the branch or a P will have to register and pay for its taxes, which is that pay income on taxes which is attributable to its income. Or if foreign companies which have its control and management which is sitting in UAE, and therefore that foreign company becomes resident person here and then pay tax normally on all of its income, right? So there are the only two scenario in where the foreign company will become taxable immediately, because the withholding tax is at zero at the moment. Okay. Foreign tax credit, as I mentioned, is limited to the tax liability in UAE. So if in this example, a company has in country A, it is paid 200 as the income and suffered a 15% withholding, then you will only get a credit of 9% on that 200, which is 18, and not the full 30. So it will be restricted to the maximum amount, which is lower of either your tax paid or the tax liability in the country. And therefore 18 is what you will get as a credit against that. And it will be restricted to that level, right? Like I mentioned, everybody needs to register and obtain a registration number. We need to file return, but return filing is all the way allowed up to 9 months after the end of the tax year or tax period. So if your year is January to December, your tax period starts from 1st January of 24. And therefore your first tax return is due latest by 30th of September 2025 and not before that. So you can file before that if you want, but that's the maximum time allowed. And there's no advance tax. So you can pay the taxes by the time you file your return or at the same time. So that's the thing. Now, very important to understand and compare is that the tax assessment. So you file return on a self-assessment basis. What you file is accepted in principle, and necessary either refund or tax payment is calculated and taken on board, and that's all. If they find any mistake, they'll come and not choose you for audit, but otherwise this is accepted moment you file. So it's a self-assessment basis of taxation, and therefore what you do as part of your accounting policy, as part of your overall day-to-day practices, as long as they are not detrimental and they are consistently being followed, they'll uphold that and then take it up from there. Okay, so it's a self-assessment base, and we file it and we take it up. And audit is only if the authorities pick and choose and audit you, and not otherwise. Okay. We will need to maintain records for up to 7 years now under the corporate tax law. Some of the taxpayers will need to have audited accounts to be submitted. Which one is to be notified in the new rules which we are expecting. And there's a very important provision in the law which we have enjoyed even in the VAT time, that here we have an option of going and asking for a clarification from the tax authority. on any matter which is not clear, you can approach the tax authority and ask for a clarification, which is like your advance pricing or any similar or advanced ruling mechanism that we have in India. So as you know that those are rare and those are time consuming and all of that, but here that's not the case. One, it is free. Second, you need to submit and they respond to you within a certain time frame on your clarification, and it's binding on them. So all of the condition of an APA is satisfied and it's available easily. And we have seen in the VAT time that this was very frequently used by taxpayers, very widely used for any of the aspect which was not very clearly defined in the law. Okay, so this is a very good tool also available here. Very simplified compliance obligation, and there will be a threshold above which only the transfer pricing and other things will apply, and those relief will be available for the small businesses as well. Okay, so if you look at overall, the intent is to keep the compliance very simple and keep it as little disturbance to business as possible. Okay, there are minimum adjustment between the financial profit and the taxable profit. As we have seen, there are only 3 or 4 which are non-deductible, and there are only 2 where you have to make adjustment. Rest all is taxable and deductible. Okay, it introduces GAR from day one, and therefore one needs to be mindful if you want to change anything now with a view to take only tax advantage. So if you have a commercial rationale, of course you can do it at any point. But if you do not have commercial justification, it will become difficult. And some details are awaited as part of the implementing process. And of course, those will clarify the things further to implement it, right? And we recommend everybody to start taking care of a high level assessment based on the law, review existing structures and evaluate if you can do alternatives, you can embrace certain restructuring or not, if you have proper commercial justification. Adopt changes to compensation mechanism of the shareholder, director, related parties, because otherwise those will be definitely not allowable, because if it crosses arm's length, then you will not get that as a benefit. And prepare to have sufficient information available for TP. Surprising, as you all know, is a cumbersome process, and one needs a lot of effort to keep those documents. And then in-house team and training thereof is also of utmost importance. Now we turn our attention to some comparison, which will be also very useful information for all of you. You are used to a fixed tax year. We do not have a fixed tax year. Any financial year that is followed by a company can become the tax period for them. We have varying tax rates. Here in UAE, it's only 1, 0, or 9. There are only 2 rates, and that's all. Okay, free zones, we have deduction days on turnover and a few other criteria, and for certain number of years only. Here it is either 0 or 9. If certain income is there, it's 0 or it is 9, right? In India, your advance tax and withholding tax are applicable, and both returns to be filed and filled up and all that. No advance tax, no withholding tax at the moment, and therefore no return to be filed and nothing to be matched from that point of view also. Okay, interest, we do have interest expense deduction on payment to non-resident at 30% of the EBITDA, but here in UAE it's a capping, so any interest paid to anybody, whether local, domestic, or international, whether to financial institution or to related party, the cap is 30%. Okay, and above 30%, if you have excess, you can carry it forward for next 10 years to be set off against next years, where if you might have those buffer of interest expense being less than the 30%, you can claim that excess which you not deducted earlier, right? Transfer pricing, as I mentioned, in India, it's mostly applied to cross-border and very specified domestic transaction. You have concept of associated enterprise, which is aligned with the tax treaties, and you have 26% of the threshold to trigger transfer pricing. Here we have 50% of the threshold, and related parties you're only up to second degree of the kinship, you're up to fourth degree of kinship. And you do not have directly the connected person concept in transfer pricing. We have the connected person also covered within that embed. Okay. And for GAR, you have a threshold of 3 crore to be applied for any such transaction to be disregarded. Currently, we do not have any threshold on GAR provisions. There might be some, but we are not yet sure. But in the law itself, there is no threshold per se. Okay. So just to give you a perspective from India point of view as to when we compare, uh, what's either more complex or what's either more simple, you know. So that's something for you all. Feel free to ask your questions, and of course, this presentation will be sent across to you, so you can refer it to that very easily as well. We will now turn around and take questions. We have been answering some of the questions which has come so far, but we'll be more than happy to take more and more questions as and when you can come in. Okay, so we have been active. My colleague has been active on the chat and the questions, and we have been answering some of those as well. So if you have a few more questions, please feel free to post in your Q&A box, and we'll take it up and we'll answer them as and when uh, you post it. Okay, so I'll just take some of the questions live. So Vijay Lakshmi has asked how tax slab is fixed in UAE. So like I mentioned, is 0% or 9%. Up to 375,000 dirham is 0%, and above that is 9%. And there are only two slabs, and there's nothing else. Okay, so that's done. There's an anonymous question: how long does it usually take to incorporate a company in UAE? Though not related to tax, but it takes anywhere between 4 weeks to 6 weeks to set up a company. So that has been addressed. Another anonymous question is any clarity that would be what would be qualifying income and non-qualifying income? So frankly, no, we don't have clarity at the moment. But what we can tell you from practice is that even if you look at VAT and other things, uh, as long as it relates to the trading activities which are carried on in the free zone, they will get that benefit, and it may not be for everybody and anybody else. So whatever that relates to income that you earn mostly from outside of UAE, you might have that benefit available, right? So that responds to that one. Okay, we have got one more question saying that what is a civil works company in Dubai? Is it a partnership or a company? Civil works company could be contracting, could be development, could be construction companies. It depends on their license. and from where they obtained. We need to look at the license that they obtained and then comment on whether it is a partnership or a company. If it is set up as a company, it will be a limited liability company, but we would be able to respond that only once we have seen the license. So please share with us and we can guide you suitably. That's not a problem. Our email and contact details are there on the presentation, so you feel free to reach out if you need to. The increasing number of, Mr. Bhardwaj has asked this, an increasing number of remote working situations allowed in Dubai. What will be the taxation policy going forward? So look, remote working options are there. If you become, if it is an individual working remotely for something which is not related to UAE, no tax here. If you end up taking a freelance license and you then start doing activities for multiple people as a business, then you will be exposed to taxation. But otherwise, that's what we look at currently. But we'll have to look at the specific situation and kind of respond this. So that also gets covered, Mr. Bhardwaj. If you have more, please write down in your Q&A. Anonymous attendee, it is for marketing management. So I didn't understand what it is for. Okay, Mohammed Sajutullah, that sir, any link for presentation you will get on your email. If you have any other aspect, please reach out to us. So if it is a professional license, again, because it's a license, you will be deemed to be having a business or business activity, and you might be exposing yourself to taxation. So just responding that. Will a PE issue arise for foreign company allowing its employee to work from UAE? If the employee is also provided an office space and he regularly works only from that space, it could be regarded as a fixed place. If he works from home and which the Indian company or the employer does not have any access to the home or any other matter, then it may be limited. So again, we'll have to look at the international precedents on that, but there's nothing specified in the law in relation to whether you create a P just by working from home. Okay. So we'll have to use international jurisprudence to see whether that applies or not. One more question is that, can you share your comments on impact of global minimum tax with 9% CT in UAE? So those which will get covered by global minimum tax will still end up paying a top-up tax, even if they are paying 9% corporate tax. Okay. So if you are exposed under global minimum tax, then you may need to think differently and plan suitably that in a year or year and a half, you will be exposed to global minimum tax, and therefore whether it is worth doing all the effort to do a lot of other planning there, so one needs to be careful. But yes, UAE is committed to rolling out and be part of the global minimum tax, and therefore they will be rolling out specific rules to that effect. So Vijay Lakshmi, I asked, do UAE has different tax structure or has one system like GST in our country? So UAE has, like GST, we have VAT, which covers goods and services both, and it has one system only, and there's no different tax structure. Even the rate is only 1 or 5%. Okay, so it's simplified and it's kind of easy to adapt to. Aditya Bharatia's question, what if one individual owns 95% ownership in 5 companies? So unfortunately, the tax grouping policies are linked to holding subsidiary relationship. An individual holding 95% may not qualify directly for that. So you may not be able to do that if individual owns. But of course, we'll await more guidance on that. Okay. Is it possible to form tax group for LLCs 100% holding by single person? Like we mentioned for Aditya's question, you need a parent subsidiary relationship. An individual, whether it is single person or so, you in UAE you are allowed, only one person is allowed to form a company. You don't need 2 people, right? So you can own 100%, but you need a parent subsidiary relationship to form a tax group and not otherwise. Okay. Mohammed Sajidullah, any law firm link? No, sir. You will have to reach out to some of the website or put it on LinkedIn and other things and see if you can find something. Yeah. All right. So we have managed to respond to all the questions that has come so far. All right. So Komalji, you want to take over and conclude the session, or is there anything else that you want to?
Thank you, sir. I just want to express my gratitude for your exceptional presentation. Your precise explanation of the subject matter is highly appreciated. I would also like to thank the participants for their cooperation. Thank you all for taking time out of your busy schedules to join us for this session, contributing to its success. Although we have attempted to address the questions raised during the session, please feel free to send any additional queries in writing to sales@taxman.com. Thank you all once again. We look forward to presenting another vital topic to you soon. Until then, take care and have a wonderful time. Bye-bye.
Thank you. Thank you, Komal. Thank you, everyone.